And I'd like to actually start with Jerry, the economist, and if you could just sort of give us a very abbreviated overview of kind of the macroeconomic indicators that are impacting housing markets in both Asia, and I know you know all of Asia, as well as here in the US, and some of the inflationary headwinds and what the Feds might do with interest rates. I think they kept them flat the last meeting, but always some concern about that, particularly in the real estate world and cost of capital and everything else. So, Jerry.
So thank you, Tim, and thank you to the Asia Society for sponsoring this. That's a big task.
I know it is.
How long do we have?
Like, I wish this were a week-long conference, but unfortunately, we have like 40 minutes, so.
Anyway, let me be brief. Let's start with the U.S. And, there is this narrative going, which has been going on for 18 months, that next quarter we're going to be in a recession, or next month we're going to be in a recession, or we are in one. And it's just false. And, when you make these forecasts, next quarter we're going to be in a recession, it doesn't happen next quarter. That's not really a forecast. That's like a broken clock that you're eventually going to be right. The underlying economy in the U.S. is very strong. And we're talking about housing today. My colleague Ed Leamer wrote a paper that the business cycle is the housing cycle. And what he meant by that is that most recessions that we see are because of an overbuilding of housing. And then the Fed raises interest rates, mortgage rates go up, and we have a surplus of housing, and there's a big contraction in housing. Nothing like that is true today. We have not overbuilt housing in the US. And in fact, because interest rates have gone up and many, many households are locked into very low interest rate mortgages, they're not selling even though they might want to upsize or downsize, which forces individuals who can afford homes today, and there are plenty of jobs and incomes are going up, so there are plenty of people who can, into buying new homes. Builders are looking at those new homes saying, I can sell at good prices and I'm out of inventory, so let's build more. So instead of higher interest rates in the US driving new home production in the US down to recession levels of 1 million, 1.1 million, we're up at with permits. Last month, permits came in at an annual rate of 1.53 million, which is our historical average. So we're actually increasing home production. So if that's not going to cause a recession, you have to look at durable goods manufacturing, durable goods orders, they're up. How about automobiles? Well, except for a temporary strike, we haven't overbuilt automobiles because we've had a chip shortage.
Yeah, the chip shortage. Yeah.
So all of the interest rate sensitive sectors that should respond and that have led many people to say we're going to have a recession, they're going the other direction. And consumers have individual confidence. They're not confident in the rest of us. So that's a really peculiar situation in the US that if you ask people, how are you doing economically? I'm doing fine. I have a job. I'm getting raises. I'm not worried about losing my job. So my economy is great. Well, how's the economy doing? It's horrible. So we think everyone else is doing poorly and everyone else thinks they're doing well, but everyone else is doing poorly. The economy is really on fairly solid footing. And so one more thing on that before we turn to moving across the Pacific, and that is we're in a bit of an unusual situation because usually when national economic policy is to cool off an overheated economy, fiscal policy and monetary policy either work together or one of them is neutral, usually fiscal policy, and monetary policy is restrictive. Today, monetary policy is restrictive, though not a lot restrictive, and fiscal policy is expansionary. And so that's mitigating against this. So the US is in great shape. Now let's move across the Pacific, and we'll move to the largest economy across the Pacific, and exactly the opposite is true. There is overbuilding of housing. There is a huge excess supply of housing. There's debt issues in local government. Export-led growth, which was really important for China, is kind of dead in the water. So you're not seeing increases in demand from the EU, from the UK, from the United States for goods from China. You are seeing increases from Southeast Asia, but that's really not enough to drive the Chinese economy. And finally, Chinese consumers, Chinese households are worried about the future. I mean, we say we're worried about the future, but we're still going out and spending at the mall or on Amazon or whatever. Chinese households are really worried about the future, and they are not spending. So you don't have consumption as a driver of the Chinese economy. This is a real problem, and it means that the Chinese economy is going to be in the doldrums for quite some time, so especially in residential construction. If you move from there to Japan, and we're going to talk a lot more about Japan, but this is true about Japan, it's true about South Korea, you have declining populations, which creates over time redundant housing, although their economies are really in pretty good shape. And if you go to Southeast Asia, kind of that's South and Southeast Asia, that's where the action is. So Indonesia and India, you have growing population, you have rapidly growing economies. You know, there's where some real opportunities are. Similar, but not quite as robust, is Malaysia, it is Vietnam, it is Thailand. And so you've got some robust economies in Asia. You have opportunities in Asia, but they're different kinds of opportunities because they're very kind of different cultures and different economies. So it's very much a mixed picture as we talk about residential construction and housing markets across Asia and the United States.
Thank you. Just a couple of follow-up questions. You know, a lot going on in the world these days, huh? One related to that we are definitely building more housing in the U.S. than we have previously, but historically we are not building more housing. We built a lot more housing post-World War II and when we had housing booms here in Southern California and around the country. But so we still have a tremendous supply demand imbalance here, particularly on the coast. So maybe you can comment on that. And then I've also read some recent articles. Everybody's sort of waiting for interest rates to sort of normalize or go back down and unlock the economy and investment again and transactions and transaction flow. But I've heard recently that we might have to get used to higher interest rates for a longer period of time than we had hoped or anticipated. So what do you have to say about that?
Sure. So you're right that since the summer of 2006, we have underbuilt housing in the U.S. It's kind of, you know, it's sort of not fair to compare going back as far as you did because
yeah, of course.
That's when the greatest generation came back from war.
Yeah, GI
had all of us baby boomers, yep. And so we had a really fast-growing population and demand for housing. But nevertheless, even with the growth in our population over the last 15 years, we have very much underbuilt housing, and we're supply constrained. And that's part of the reason why we see an increase in home prices. Another part of the reason, and I think we'll get into this, is what the pandemic wrought. That now that we can work from home at least part-time, for a segment of the population, that home office doesn't exist. And so not sitting on your bed with a laptop, but actually having a little more space is more desirable. So you get increased demand for larger space homes. So I think all of that is going on, and we are definitely supply constrained. If we build at 1.53 million, we're not going to ease that supply constraint very soon. Interest rates. The way to think about interest rates is this long period that we all got used to of near zero interest rates. That was the unusual period. The interest rates we're seeing now are much more normal. How long will the Fed keep going with interest rate increases? Our best guess as to what the Fed is going to do, and of course they can always change their mind, is that they will probably before the year's out, do another 25 basis point increase in the Fed funds rate. That doesn't move the needle as far as the economy, 25 basis points. But what it does do is signal that, hey, we, the Fed, are serious. So we think that they're going to provide that signal. What we do see in terms of the impact of interest rates, as we look into 2024 is that while they're not going to drive us into a recession, they're going to slow the growth of these interest-sensitive sectors. They're all going to grow, but not at average rates, not at as historical average rates, which means the economy in 2024 is going to be weaker. And so what we think is going to happen is the Fed's going to make a few minor adjustments to the interest rate, bring it down a little bit, as a way of saying we're ready to move if we need to, but we don't really need to. And part of that is because inflation is coming down, employment will still be strong, but real interest rates, you know, when you take inflation out of the interest rate, real interest rates will be going up. So they'll be moderating that to take into account those tighter conditions. But look for upper fours for the Fed funds rate, and look for the kinds of rates that we're seeing today as being there for at least some time, because those are really normal rates.
Yep. Yeah. My parents remind me that they paid 16% on their mortgage back in the 70s, but then I remind them that they also paid $60,000 for their now $2 million home. So it's
right.
Why don't we move to JP? You know, so you're in Asia Pacific primarily, and so in I think all of Asia. So evaluating, you know, what sort of markets over there are you looking at? Where do you see promise, opportunity? And I guess a related question is, you know, we've been reading a lot about population decline in China and Japan and how that might be impacting things, as well as some of the migration that's happening. You know, talk about rural versus urban migration in China, for example. So what do you say there?
All right, so I'm going to start at 100,000 feet. So at 100,000 feet, my book in China, so a little bit about PAG. We're kind of like a mini Blackstone. So we're private equity, hedge fund, and real assets. So real assets is real estate and infrastructure. So 10 years ago, my book was about 20% China. 10 minutes ago, my real assets book was about 1.5% China, and if it could be zero, it would be. So that's my thought on the opportunity set. You know, we're really developed Asia. So talking about growth in Southeast Asia, there's a lot of difficulties as an institutional real estate investor in a lot of those markets. Your ownership rights aren't that great. Governments can change pretty quickly. The only place where we really move into developing Asia is really in our data center business. And the reason for that is, you know, if I have a 20-year lease with AWS, you know, I'm probably okay, and I'm a little bit less concerned. Where we see the opportunity set, though, for multifamily, I'd say that the two best markets are Japan, where we haven't had interest rates go from 0 to 5.5%, 6% Fed funds rate. We've had a little bit of movement, but you're talking about the 10-year going from, you know, 25 basis points to 68 or something. So, you know, our margin on that, you know, we're basically at a 5% unlevered yield. I can finance at 75, 80%. So pretty quickly, you can see that I'm carrying residential real estate with very low risk at over 10.
And are you mostly value add, or do you actually do ground up stuff too?
We'll do ground up and multi
construction loans.
We do. I mean, but the markets that we're in are quite easy to develop. I'd say the one market of developed Asia that's quite difficult is Australia. The planning is terrible there, so there is a bit of a housing shortage, at least on the for lease side of that market, because it's difficult to develop. I'd say the best market. So what's interesting is, as bad as the for sale market is in China, there's probably an opportunity in the for lease market. I mean, most people, it's hard to access because you know, institutional ownership, which they broadly define in China as just professionally managed. So actually you have a management company. That's about 1% of the for lease market. You know, you're talking about a 50 million unit for lease market in the major cities. There probably is an opportunity, and rents are actually growing in the for lease sector, even though you've got actual housing prices in the for sale market dropping 10 to 15% per year, if you can build it and sell it. So we think that's actually kind of an interesting market. The other ones are generally home ownership markets. Like Korea, you're basically 60% home ownership. They have a very interesting structure, what's called a Jeonse, which is like a upfront deposit structure. So you're not really collecting rent. If I do a 5-year lease, I'll get all 5 years upfront, and then it amortizes down. So it's pretty difficult as an institutional investor.
Yeah, and then population decline and migration.
Yes, so in China, obviously, you still have a lot of population migration into the major cities. I think one thing that's under thought of there is you actually have a lot of migrant worker population moving in Beijing, Shanghai, Shenzhen. That will probably drive the for lease market, because as much as property pricing is reset in China, it's still in the major cities 40 times income. So most markets globally are 10 to 15. Japan's about 10. US is 12, 13. You probably know this number exactly. China, it's 40 times. That's with pricing coming down 30%. So nobody can ever afford a home. It's awful. But I think that will drive the leasing market. Japan and China both have horrible demographics. I think the biggest difference is Japan got rich before they got old. I'm not sure that's going to be the same for China. And if you look out 20 years from now, that one-child policy, it's very difficult to turn that back on. Japan's been trying to incentivize people to have more children for 25 years now. It doesn't really work. I mean, the only reason the U.S. looks so good is because of immigration, honestly. I mean, that's it. If you looked at white Anglo-Saxon America, that birth rate's 1.5. You need 2.07 to equalize your population. I'd say one difference for Japan, maybe over China, is people actually want to move to Japan. Japan's problem is that their immigration policies aren't very good. Their taxation policies are not very good. Like if they wanted every company from Hong Kong that moved to Singapore to move to Tokyo, I can guarantee they would have done it, but for the fact that it's so egalitarian that there's no way that, there's no tax incentives and things like that. Same thing with immigration. 2019, there's 1 million legal immigrants into Japan, which is the highest ever. They need to do that for about the next 10 years and give those people, as opposed to permanent residency, they actually need to give them citizenship. Because the reality is, people that are coming from other cultures culturally have more kids. I mean, that's just the facts. So
you also bring in more intellectual capital and
absolutely
into the country too. So you're right. I mean, Japan's been very homogeneous and probably need to open up their immigration policies too.
Well, they've opened it up for professionals, but the problem is like professionals are eventually going to move back to their home countries, right? I mean, except for me, I moved there in 1998, and I don't know, I'm like stuck in this in this vortex. But in general, most people move every 5 to 7 years. There's some taxation reasons for that. People that are a little bit lower down the skill level will stay forever because it's a great place to live and it's affordable.
Yeah.
So.
And in Japan too, I think a lot of the housing is particularly tied to transit. You talk about the high-speed rails and everybody getting in and out efficiently in the city. Is that something that you're cognizant of when you were?
Absolutely, and that's every city in Asia, frankly. I mean, generally speaking, where there's rail, you need to be within 10 minutes of it. And like what's really considered core multifamily or even for sale would be 3 to 5 minutes. High-end, less, because those people have drivers or what have you, but, kind of your mid-market stuff, 3 to 5 minutes walking distance to the station is the way to go.
Yeah, exactly. We've done a lot of studies here in the U.S., and if there is not a major public transit station within a half mile, folks are just going to get in their car.
Yep.
A mile, they're definitely getting in their car.
Well, for sure. A mile is, then you're talking a 25-minute walk. That's kind of rough.
Last mile travel problem here when it comes to housing, proximate transit in the U.S. But let's turn to Eddie real quick here. Yeah. And you're our sort of U.S. value-add multifamily investor, I think primarily on the West Coast. But it's a strategy that a lot of people are doing. You've got a lot of competition out there. But just tell us about your sort of value-add strategies and your firm's business model.
Yeah, so I started my company in 2010, coming out of the Great Recession, and the mantra that I've been kind of following is where are the high-paying jobs, and where is there a perpetual housing shortage? And so I've focused on the West Coast. It's markets that I know. The other thing is I told investors is that I would never put your money at risk for my ignorance. So I made sure that when I started my company, I would only invest in areas and markets that I had intimate knowledge of.
And your investors are institutional?
I have institutional investors. I've got high net worth investors. I've got Asian investors. I've got Japanese industrialist type.
Yeah, I don't count. So.
No, not you. So we have a pretty wide spectrum, but I've focused on the knowledge economy because I think that's where all the, really great jobs are being created in, Silicon Valley. I mean, for instance, in Fremont, California, which is pretty solid, used to be sort of a B kind of market. Now it's a B plus market, but I'm 20 minutes from basically every major, tech company in the U.S. In the headquarters, and I've got residents that are making $350,000 a year, and they can't afford the townhome next door to our building because that's at $1,500 a foot and $1.5 million or whatever for something that we can actually offer them a price alternative for their families. So for me, that really feels pretty good, especially knowing that in California, I mean, talk about a perpetual housing shortage. California will never catch up. There's zero way of actually creating enough housing for our population. And no, people aren't fleeing in droves. I think that's kind of been, talked about widely in the press, but it's just not happening. One of the things though that I can respond a little bit, I'm a little bit worried. I'm grateful that we're not going to be in a recession. That's fantastic news.
Well, eventually we will be.
Well, eventually, sure.
He's guaranteeing it.
Yeah. It's going to happen. But what's interesting in my markets, I'm also in this very, very blue state kind of environment where we've had incredible overreach by the government and incredible problems with eviction moratoria and whatnot. And so the interesting thing right now, and this is going to get, while these guys were up at 90,000 feet, I'm about 8 feet up. So what's really interesting in my portfolio, and I own from Greater Seattle down to the Inland Empire, but I've seen it kind of in every aspect, is that our evictions, now we have them again. So we're tossing people out. Great. That's wonderful. They haven't paid rent in 2.5, 3 years. It's wonderful to be able to actually move. But as Tim mentioned, there's a lot of competition in my space, and everybody is doing the same thing. So everybody is starting to evict. And the number one criteria that we reject a new resident for is that they owe a landlord back rent or back money. So automatically, while you would think that, we can actually just relet all of these units, we're actually holding back on that. And that's actually causing a huge supply-demand problem, really on the supply side. Ironically, after what I just got through saying, I'm hoping that it's a short-term phenomenon, but we're having a harder time finding qualified renters that are willing to pay these prices right now that don't have a bad credit history.
Do you find other institutional owners also holding? I could see if somebody hasn't paid rent in 3 years and got evicted, you definitely don't want to.
I don't want theirs. I don't want theirs. They don't want mine. Right. And while there's not collusion, we're just all using the same criteria.
Right.
I even had a conversation with. I generally wouldn't mind dropping my coverage ratio from. It used to be 3, now it's 2.75, 2.5. I wouldn't mind dropping it even further to like 2.25. As long as they don't have a background where they've,
eviction on your record is not a good thing in terms of being able to find another place. And then, as the eviction moratoria has been lifted, we've seen a flood of over 50,000 eviction notices go out here in California, and the courts, I don't even know how the eviction courts are going to get through all this in such a short period of time.
It's pretty tough.
So are those eviction notices or default notices?
They're filings within the court.
Yeah.
Right. So many of those will be.
They'll work them out.
They could work them out.
They'll be worked out, so they won't be evictions.
Yes, eventually. Yeah. Maybe some of them will, but yeah.
Yeah.
I would think, to your point, where basically people are doing relatively well economically, and maybe they haven't had to pay rent in a couple of years. They should have some money. Maybe that's why we're not in recession.
Well, yeah, that's part of it is that we're.
Part of it was the rescue dollars from the government and things like that. Too.
Yeah, but something that Eddie said, is really interesting. Everybody's not leaving California in droves.
No.
In fact, what's happening is because of the high cost of housing, you're finding lower income or larger families leaving, and those who are coming in tend to be highly educated. And so they're 1 or 2, maybe 3-person families. And so we're seeing household size really shrinking in California, but the demand for homes is still up, and average incomes are up.
Yeah, and that's, I mean, and I can complain about, lower occupancies, but my rent is actually increasing.
Yeah, and it's very geographically distributed. So, I mean, in San Francisco Bay Area, the average home price is over $1 million, but you could also be considered sort of low income with a $350,000 household income too. So it's a much different market than LA, where we've had very low wages. Yes. And so there's a big affordability gap. But let me ask you too, since you're eight feet,
maybe 10.
10. In terms of cost of capital, interest rate environment, and your borrowing costs, and trying to find construction loans, and how are you going to refinance at some point? How's that going to impact them?
Yeah, so I have a nice can that I just keep kicking down the.
Yeah.
It's tough. We're in the market right now on a refinance, and we're talking about a pay rate of somewhere in the 8.25% range. It's quite a difference from the low whatever, like the 4-ish or the 3.5 kind of range that we were in a few years ago. But at the same time, our incomes are going up. So
yeah.
One of the projects that I actually have right now that is on one level, I would say, oh my gosh, I'm like writing checks and feeding it. However, it's one where I had 11 people in eviction, and it was a smaller building, about 80 units. I'm usually in the 200-ish or 150 category, but this was about 80 units where I had 11 people not paying rent for 3 years. Yeah. So that's a really, really hard way to make a living. But right now, I've now gotten them all but 3, and now they're being relet, and I'm getting a lease trade out of $500. So if it's a 2,050 unit, 2,050 price per, for rental, price.
Yeah.
Now I'm signing leases at $2,550. It's incredible. So you take that, show enough lenders what is actually happening in the actual asset itself, and kind of forecast a trend, then I feel like, well, that might actually work out okay for me.
Yeah, you've re-rated your building up 20 points.
Yeah, exactly. So, and hopefully with time, that kind of thing will ultimately pay off.
Yeah, and you're on the West Coast, which is, as you're right, I mean, we're always going to have a housing shortage for as long as we're alive here. So it makes sense to be here. But I can tell the audience that on a national perspective, there are a lot of multifamily developers that are going into the Sun Belts. They're going into Texas. They're going into the Southeast. They're going into Atlanta, Raleigh. And I think because you're just getting more yield there, and it's also not nearly as onerous in terms of the regulatory environment to build in some of these places as well.
Right, but the problem is when all of my brethren ran to the Sun Belt, so did all of the developers, and so did all the money. And now that is a market. I don't know if you're seeing that, but I think the Sun Belt is soon to be an overbuilt market.
Yeah.
And there's nothing, cap rates are going to be higher everywhere. I'd much rather be on the West Coast.
Yeah, we're seeing that in Phoenix. We're seeing it in Austin now.
Yes.
And in Denver. Yeah.
Yeah, and so what happens in the longer run is you have rent degradation in those markets. And so the yield that you thought you'd get because you're in a red state, it's not happening.
Yeah. And another issue that drives up costs in addition to the interest rate environment, and any of you can answer this, but cost of construction has skyrocketed, both material costs, although it's come back down to sort of pre-pandemic, but still have supply chain issues. And then, of course, labor markets is the big deal, too. So either in Asia or in the U.S., what are the costs of sort of construction these days?
Up 20 to 30%, depending on your market in Asia. And so what was like in Japan, which has historically been surprisingly a pretty inexpensive place to build. So the cost of construction was about 1 million yen per tsubo. So just quick math as maybe $250 a square foot. It's more like 2 million. So it's really almost doubled. And like high-end residential, those costs have probably tripled. So I said 20, 25%, but that's across everything. Yeah. Some sectors, it's a lot more. Like if you're building a data center, that's probably 50% more expensive.
Right. So. And then can you pass that cost on to the market? Will the market?
We'll see.
Yeah. One of the issues there is still supply chain constraints, right? Because a lot of what goes into building a new home is made in China. Yeah. And with the zero COVID policies for 3 years, so, think about drywall, about light fixtures, and you just kind of go down the list of things that were coming from China because it was the most efficient way, the cheapest way to get these things to fit out a home. They weren't showing up.
Yeah.
And so you get big spikes in prices. Hopefully, now that China's given up on zero COVID and is concerned about getting their exports moving, we'll see those prices come down. But
well, you're really seeing it in solar panels, which historically over the last 15 years have been dropping, 5-10% of cost, but well, not when there's supply chain issues and 70-80% are made in China. So yeah.
Right, exactly. And we had a real shortage of drywall for a while.
No.
Lumber costs were through the roof. It was pretty crazy. So let's try to be quick in our answers now because we're running out and short on time, but I'll just jump around a little bit. Jerry, I know that the forecast is doing a lot of work right now on climate change and how that impacts the built environment and housing in particular. And you see it particularly in Florida and coastal areas, and then of course you see California with wildfire. And I think one of the greatest concerns is that even in the insurance market, when they look at evaluating risk, they're not even offering insurance in California anymore, if you've been reading the newspapers. So climate risk and its impact on residential housing markets.
So really quickly, when we think about the west coast of the U.S., most of the west coast of the U.S. is upland, right? And along the coast, not where the wildfires are. Now, we have to be a little careful. There are inland cities, when we think about the Tubbs fire and the things that happened in Santa Rosa, and these are really tragic. These are the places where you've seen insurers pull out. There's, of course, a new deal with insurance companies, and they're coming back in, but wildfire insurance is going to be much more expensive, particularly in those areas. But for things like sea level rise, in the Bay Area, there's a real concern, in Alamitos Bay here in Southern California, but most of California residents live upland of sea level. When we go across the Pacific, we get exactly the opposite. When you think of Jakarta, it's got 11 million people and it's sinking. And admittedly, they're building a new capital in Kalimantan, but you're not going to move 11 million people out of Jakarta. You have the same thing in Ho Chi Minh City. You have the same thing in Bangkok, a city of 16 million people, Mumbai, and in coastal China, in the Pearl River Delta. If you know Shanghai, there's a part of Shanghai when I first was working in China, it's called Pudong, and it was just a mud flat. That is not above sea level, and sea level rise is going to have a big impact there on housing. So we talked about the housing shortage here, which is in part because of regulation, but in part because of our topography, mountainous topography on the West Coast. Housing in Asia is going to be very much restricted by the loss of housing over the next 20 to 30 years, but it starts right now.
Yeah, there's also this issue of extreme heat, which I didn't realize, but extreme heat is the largest killer of people of any natural disaster. If you look at a place like California or the Pacific Northwest that had a heat dome and there was lots of life there, building and safety codes they require heat in every house, but they don't require air conditioning in every house. So maybe that's something we need to revisit as builders of homes that are healthy. But turning to JP and maybe turning the tables a little bit, we've been talking about a lot about Asia. What about the retreat of Asia capital into U.S., which we've seen a tremendous amount happen recently, Evergreen and Wanda.
Yeah. I mean, I'll maybe go by country. I mean, I think China is largely an effect of the problems that the actual developers are having themselves. They're having very difficult times actually repaying their own bonds on the debt they already have, which is exorbitant. Japan, actually, the developers are doing quite well. The issue they have is a historically weak yen. I mean, when your yen's 148, I did see Mori just bought a large office building in New York, which, with a yen at 140, that over time probably goes back to 120, you're requiring a lot of growth. And the problem is, so I'd say the best thing to do is take US dollars and invest it in Japan, because the interest rate differential, when I hedge it, I make 6 points a year. It's exactly the opposite if you take yen and try to invest in the US. And if you hedge it, it's minus 5.5% right off the top of your yield. And then the Koreans, where the economy's actually done pretty well, their currencies, obviously it's weakened against the US dollars like most things in Asia, not nearly as bad as the yen. problem they have is they actually have a lot of U.S. office exposure that they went into 5 years ago. So if you bought, coastal city U.S. office exposure 5 years ago, you probably are looking at somewhere between a 30 and 60 point write-down. Nobody at Mirai Asset Management's investment committee is going to sign off on doubling down. Although it might be a good time to do that, but
Yeah, and you said you're starting to see some Japanese.
You are seeing some Japanese because they want the growth. They think it's unlike the 80s when they were the top of the market. I think the Japanese feel like this is probably, for the right buildings, pretty close to the bottom of the market. Yeah, I just think with the yen so weak, it's pretty tricky. I mean, they're going to need a lot of growth to compensate for the fact that they could lose 20 points on the currency. So.
Yeah, for those of you that were not around in the 80s, the Japanese had a pretty bad time here with their market timing in Los Angeles downtown.
Well, right. Well, that's what a lot of your Korean institutional investors look like right now. So, which explains why they're not in the market.
Yeah. And then what about capitalizing on distress? Are you looking at distressed debt on resi? And
So I had an interesting conversation with Mr. Nishida. So when you were talking about 8.5% interest rates, his eyes were like lighting up right there. So I am a distressed investor. So I moved to Asia in 1998, right after the Asian financial crisis. Mm-hmm. So where Oryx might be sort of a lender of last resort, I am the absolute lender of last resort because I'm agnostic whether you pay me back or you don't, because my loan's going to be about 50 cents on the dollar, and it's going to be expensive, and I want to own it. Where we took advantage of that a bit was in the hotel sector in the middle of COVID, where we were able to get some pretty interesting basis on assets.
Yeah, some of the hospitality returned pretty quickly.
Yeah.
And, this is sort of a question for any of you, too. We've seen this phenomenon of Wall Street coming in and buying single-family homes for rent in the United States. I don't know if that's happening in Asia at all.
Not so much. I mean...
Right. But, there's a lot of debate about moral hazard and that kind of thing about Wall Street coming in and owning so many homes for rent. Any thoughts on...
I mean, Blackstone's the largest owner of residential in the United States, aren't they?
Yeah. There's homes for rent. There's a bunch of others, too. But they've flooded into the space now.
Well, I think one thing that's interesting is you don't really have single-family homes for rent, at least in developed Asia where we are. I mean, basically, home ownership's pretty high. With the exception of Japan, it's 60 to 70%.
Yeah.
So you don't really have single-family homes that are being let out. Generally, people have long-term mortgages and they pay them.
Is there a homelessness crisis in Asia?
It depends on what country you're in. I mean, I think in developing Asia, for sure. Mm-hmm. I mean, as great as the economy is in India, there's a lot of people that are like poor beyond like what you would imagine poor to be, right? In Bangladesh and countries like that. Developed Asia depends on the country. A little bit in Australia, a little bit in New Zealand. Japan has some. It's kind of a worst kept secret in the world. But I think it's not like walking around Santa Monica. Right?
Yeah.
I mean, so.
Yeah, we're pretty much ground zero here in Southern California.
Wow.
70,000 homeless people in the county. So, I'll ask one more question before we go to questions from the audience. I did see the word innovation in the flyer for this event, and we're looking at a lot of different innovative ways to either finance or build or whatever. There's been a lot of talk about modular or prefab or factory-built housing as sort of being the answer to our affordability crisis and to getting more housing online. Have you guys started to look at that at all? Or
we've looked a bit at modular. The cost differential is not huge.
It's a time savings, not a cost.
But it is a time savings, and it's a labor savings, which that's really where you see a lot of time and cost. Now that material costs have stabilized a bit, you still have a huge shortage of labor.
Yeah, rather than having a bunch of union labor, prevailing wage labor on your site building and construction, you're basically manufacturing these things on site, and you're saving a lot of time, and you're saving on the labor as well.
We haven't, our sort of innovation in the last couple of years has been to identify some interesting prop tech kind of software solutions. And one particular organization, we basically became the beta test for them and helped them develop their product. But what it's done for us is that we've been able to centralize a lot of our operations. So instead of having 4 people at a building in the field, now I've got 1 or 2 people, and I'm housing others in my corporate office. And that's done a number of things for us. It's smoothed out our operations so we can actually have a consistency of operations without worrying about whether the person in the chair in the field is showing up or quitting or whatever they're doing. So that's actually a prop tech innovation that we.
Yeah, we didn't get a chance to go greatly into fintech or prop tech technologies, but that's changing the industry, not just residential, but commercial as well. Real estate has traditionally been a very old, arcane, a lot of intermediary, signed contract type of a business, and so it's ripe for disruption. You see a bunch of technology platforms and VC coming into the space to try to disrupt it. On the residential side, like all rents are collected now online. If you want to look for a shop for a home, you can go to Zillow, Redfin, any of these things, and there's much more efficiency and information in the marketplace. So that, unlike being able to make a fortune for assets on 10 cents to the dollar back in some of the other downturns, the markets are too efficient to do that.
The markets are very
efficient. That
efficient.
includes residential real estate as well. So, so anyway, that's just a flavor of things that are going on. So I thought, in fact, I've been instructed that we need to reserve some time for Q&A, and I think there's somebody that's going to run around with microphones. So happy to take some questions from the audience.
Hi. You talked about the last 3 years with COVID and people working from home, the hybrid situation. So there's been a real contraction in the office space. People are not going to office, and so they're consolidating office space. Whereas a firm might have had 2 or 3 floors downtown LA, now they have 1 floor. So my question has to do, maybe all of you can address it, is the feasibility or the cost effectiveness of adaptive reuse, converting office and then the rezoning.
I can answer pretty quickly. The issue is that it's incredibly expensive. These Class A buildings are not constructed to flip to residential. They don't have the infrastructure. The floor plates are wrong. The loads are wrong. And also the issue is that you would have units that are very deep. And so you would probably want to have your windows up in front with your living room or something, which means people would have to get used to bedrooms without any natural lighting. So that creates an issue. But generally speaking, with newer Class A housing stock, it's more expensive to rehab it than it is to actually tear it down and just rebuild a residential property. Now, where it does work is some older stock. Yep. Some of the older stock is easily flippable, and that's been done. So we do have an adaptive reuse ordinance here in Los Angeles. That you've actually been able to utilize hospital buildings or whatever and turn them into residential. But it really only works for older stock where the building...
And smaller floor plates, for sure.
Smaller floor plates as well, too. So the issue is cost. I think what will happen with most of the Class A office spaces in places like San Francisco or downtown, we'll see if people begin to come back to work. I mean, I think we're not quite back to the occupancy rate we'll ultimately get to, although we'll always see some work from home, which has also shifted preferences in where people live too, demographically. But I think what you'll ultimately see is, and we've already seen this, right? We see institutional investors handing the keys to the, back to the bank. Somebody will buy that when the price comes down far enough, and the market will just reset. They'll just say, come to our building next door, brand new, same building at half the tenant cost. That's probably what will happen. But older stock, you can definitely, I'm a huge proponent of converting into residential if that can happen. There's been some here in Los Angeles, particularly Koreatown, where some of the buildings were built sort of like in the 20s. You can flip those, and there have been several flips. There's a group called Jameson Realty that does a lot of that work right now and has sort of been leading that. But that's a short answer to your question.
You're the value add guy. Have you looked at any of that?
I have, actually, and for all those reasons that Tim just said, it's just never quite works, right? I was involved when I was at Kennedy Wilson way back in the day with the Pegasus downtown. And that actually did work pretty well, and then a couple others that I was involved on the management side. But it was, it's too hard.
It's very difficult.
What you're going to see with this Class A and some of the Class B is, and you're already starting to see this in San Francisco, is those buildings are going to be sold for a fraction of their value 5 years ago. The new owners now have a lower base. They'll charge a lower rent. And yes, each firm will take less space because they just need kind of creative space. They don't need everyone to have an office of their own. But those lower rents are going to bring more firms in. And there were just a couple of big signings lease signings in San Francisco. And it takes a few years for that to work its way through, but that process has already started. I think there's a realization that office buildings were overvalued relative to today's environment with hybrid work.
His phone just said a big savings, so there you go.
As an old NPL guy, which is not performing loan, there is a price for almost anything. So.
Yeah, there was a building that just traded in San Francisco, office building, pre-pandemic valued at 360 million, just traded for 60.
Went out at 60, right? Yeah. But I mean, more and more that's happening, and even if it doesn't happen, it's going to a particular owner.
Yes.
It's going to force their rents down to market.
Yeah.
So we'll see rents coming down for office space, particularly in San Francisco, in downtown LA, in New York.
And we can do a whole other panel on office for the next time we do a program for
exactly.
society. But it's a good question. You know, we have a shortage of housing and we have a glut of office coming online. So why wouldn't you try to figure out how to use it? I think there was another question back here. Yep, there's a microphone right behind.
Yeah, there's another giant around the corner with the pharmaceutical technology, IT, and all that. It's the mostly populated country in the world, India. So where do you see, they are behind in terms of residential development, but that gives us another opportunity, particularly John would recognize that. So where do you see India fit into this conversation?
I guess that's for me.
Well, you're the Southeast Asia guy.
Yeah. So. I'm developed Asia. I'm still deciding if India qualifies as developed Asia. Big opportunity. I mean, the only place that we've really looked, though, is on the luxury residential side. But actually, as you have incomes increasing, certainly the mid-scale market's incredible. You also have, in India, net migration into the cities. I mean, I do think as you look forward, it won't be an opportunity for us. I mean, where we look at India is really kind of only in our data center business. But it's, you know, you have an economy that's growing at 6-7%. You have an extremely business-friendly environment, and I think India is sitting in that great position where they can sort of be part of like the Western democracy, but also buy, you know, really cheap Russian crude at the exact same time. So India is probably better positioned than virtually any other country.
They're the only I letter left in BRICS, right?
I know. Exactly. But yet they're still part of the Four Eyes, you know, security with the U.S. I mean, they're really well positioned. So,
Jerry, you have anything to say about that?
Yeah, I agree with that. You know, historically, when an economy grows, when you see expansion of business, you see people from the countryside, you know, who are peasant farmers moving to cities. And that's happening in India, and India has a huge peasant population. So expect to see that happen. The problem with India, if you look at a map of where sea level rise is going to bite in, say, Mumbai, it's going to take a large part of that city. So there are real issues of climate change. The other aspect of that is increasing intensity of monsoons and increasing heat. So all of those are kind of factors that make India a bit of a wild card, but it's growing rapidly now. And I think there are real opportunities, in places like Delhi where people are flocking to.
No.
Just surpassed China in population, actually. So it's
yeah, that's going to bifurcate quite a bit.
Yeah, the Chinese population is shrinking. The Indian population
growing rapidly.
Is growing.
No. Much higher. It's slightly higher now. It'll be much higher 20 years from now, and it's very young, also. So.
Yeah. Any other questions? Yeah.
We're talking about migration, more people moving to California than not.
Well, we actually seen more out migration in California, but we are seeing more people come in, and as Jerry mentioned, they tend to be highly educated, higher earners, and bring more intellectual capital.
We're seeing all my friends are moving out, not in.
We're seeing smaller families or smaller households moving in, larger households moving out, right? And we have been talking about climate change. If we think about where many of these people, I don't know where your friends are moving to, but I'm sorry?
Red states.
Red states. Yeah, and when you think about the impact of climate change on many of those, the value of living in California's climate is going to go up. And so we're going to see kind of a real churn as to, who values that. The California's population has gone down kind of marginally, but we don't expect it to continue to go down. One of the aspects of that, and we're talking about housing, one reason to move from say, Los Angeles to Austin is to get cheaper housing. No longer.
Yeah, definitely no longer on that.
Austin is as expensive as California, as Los Angeles. Boise is as expensive as Sacramento. So people move for a lot of reasons, but for housing cost differential, that's really kind of disappearing. There's still going to be a differential between California and inland, between Seattle and inland, just because of the natural amenities and because of the climate.
We've seen a lot of migration to the Inland Empire from Los Angeles metro, and it's really because of housing costs. I mean, they'll incur the transportation issues, but they want a house, they want quality of life. Of course, they lose some of that on their super commutes too. And we've seen a few people leave California for politics. They want to move to a red state. They're sick of the liberal environment here and the regulation. But
Lead singer of Metallica.
yeah, but it hasn't. Yeah, exactly.
Right.
But it hasn't been great, you know. And even some of the out migration in San Francisco Bay Area, that's where you play. The folks didn't necessarily leave the state. They just left. They went to tertiary markets around because they would drive in for their 1 or 2 days, but then they would live in a where the housing cost of housing is.
Right. I mean, there's been a boom in Sacramento and Stockton.
Exactly.
And the reason is if you only have to be in San Francisco 2 or 3 days a week, this provides affordable housing and the commute's not so bad, right? If you have to go through the Altamont Pass every day,
that then
grind on you. But if you can take, the train in from Sacramento and then BART, maybe not perfect, but certainly, doable, and it's not gonna.
The other thing people tend to not talk about once, like, your friends have left, they don't talk about the insurance. They don't talk about the taxes the property taxes that you have to go and try to fight the assessor's office every year. So there are things that are like hidden costs to moving that people kind of don't really want to talk about.
Right. If you take the middle class California family and the average tax that they pay, it's about in the middle of the 50 states. It's not. Income taxes are high, particularly if you're in the upper income brackets.
Right.
We have higher earners in California.
Sorry?
We have higher earnings in California.
But we also have higher earnings. But middle income Californians are paying on average about the same taxes as you would in most other states, or the average for the U.S.
Have you noticed, talking about smaller families, and we've seen that in a lot of places, obviously like Japan, there's net migration into the cities, but where you really see is the number of households really, has that changed the demand of your units? Do you rent more 1 and 2 bedrooms than 3 now, or not really?
What's funny is it's one of the indicators that I instructed my team to really focus in on about 1.5 years ago, because everybody was talking about the recession that was, coming. The indicator would have been nobody wants a 3, nobody wants a 2, everybody wants 1s, or nobody wants 1s, they all want to double up on 2s and 3s. And we actually haven't seen any of that.
Got it.
So it's been remarkably pretty stable.
Yeah. What about studios versus 1s?
Our studios go very quickly.
Yeah.
Very, very quickly. So there will be that price-conscious renter. We actually did an ADU at one of our buildings. We built 2 of them out of like an old laundry room, it was rented. The second we put it up online
Immediately,
Castro Valley, it rented, and I think we're getting on a per foot basis. It's something on the order of $5.80
right,
or something like that.
Right. So let's just say your average rent in Fremont for a studio.
It would be like in Fremont, you're probably looking at about $1,900, $2,000 for a studio.
Yeah, which has been a traditionally more working class neighborhood in the Bay Area.
Yeah.
A question on your multi-fund. What's it cost you to develop a unit?
Yeah, so
What's that between permitting and regulation?
So what I can talk about, we don't do ground up construction, but when we do look for these opportunities to build out ADUs, which is accessory dwelling units in the
like a granny
code,
flat.
it's kind of cool. You're taking a defunct space and monetizing it. That costs roughly $100,000 per unit to take existing space. So it makes sense all day long because the darn thing's worth $300 to when we sell it on a average basis.
Regulations, permitting.
That's all in about $100,000.
Yeah, so if you're talking about, he does mostly rehab work. If you're talking ground up, it is incredibly expensive.
Oh my God, yeah.
Parking requirements. You're talking
today,
entitlement process.
Today, a ground up building in the markets.
Well, I know developers that won't even build in California.
The markets that I play in, it would cost $650,000 to $700,000 a key.
Wow.
To build.
Yeah,
Which is why there's a housing
shortage.
That's why I'm in my business. I'm happy.
Yeah, this is the fund you want to be in. The guy renovating stuff.
Yeah.
Exactly.
Yeah.
Anyway, we are just about out of time, so please join me in thanking our panelists. We really appreciate your time.